Okay, let's dive right in. We're looking at a really big one today, the strategic demerger of Tata Motors. It officially happened, what, October 1st, 2025? So our plan is to break down how this split actually works. And fair warning, there's some slightly confusing name stuff involved. Then we'll get into why they did it, the strategy behind it, and finally look at the risks, what concerns the market now has with these two separate companies.
Yeah, and it's fascinating because the split, it's basically the company admitting, look, running JLR, this global luxury brand, alongside, domestic trucks and buses.
It just wasn't working smoothly under one roof anymore.
Exactly. It was creating drag. So this is like a corporate surgery
Yeah.
designed to unlock value for shareholders, let these two very different businesses finally focus and, well, grow aggressively on their own terms.
Okay, let's nail down these mechanics first, because if you're an investor, you need to know this. The name swap is probably the trickiest bit. So the original listed company, it holds on to the passenger vehicle business, the EV stuff here in India, and of course JLR. But its name changes to Tata Motors Passenger Vehicles Ltd, or TMPVL. Let's maybe call that the CARS entity for simplicity.
The CARS entity, TMPVL, makes sense. And then, crucially, the commercial vehicle business, the trucks, the buses, that whole legacy operation that gets spun off, it becomes a brand new, separately listed company.
And that new company gets the old, iconic name, Tata Motors Ltd, TML.
Precisely. So TML is now the trucks. You just have to remember that shift. TML equals trucks now.
Right. TML is trucks. Got it. And for you, the listener, the shareholder, the actual share distribution, that part's clean, right?
Oh, yeah. Extremely clean. They've set it up as a simple 1:1 share ratio. So based on the record date, October 14th, 2025, for every single share you owned in the old combined Tata Motors.
You get one share in the new TML, the truck business.
And one share in TMPVL, the CARS JLR business. You end up holding two distinct stocks representing, two very different investment stories.
Okay, now here's where it gets really interesting for me. The why, the strategic thinking. Did this feel like just optimizing things, or was it more urgent, like something had to change?
I'd lean towards urgent, definitely driven by competitive heat. Yes, focused capital allocation is a big part. I mean, B2B trucks and B2C cars, they need totally different approaches, different investment cycles.
Sure.
But the real kicker, the urgency, I think, came from the cost of keeping them merged. Look at the numbers. The commercial vehicle domestic market share, which should be their bedrock, right? It fell, plummeted, actually, from 45% in FY22 down to just 36% by FY25.
Wow. 9 points of market share lost in the core truck business in just 3 years. That's a flashing red light.
It is. And what's really profound, I think, is the internal admission that came out. Senior people basically conceded that compromises were being made. They had to shortchange the CV business, the cash cow, to prop up and fix the passenger vehicle side.
So they were sacrificing the profitable truck side to get the car side back on track.
That's what the admission implies, yeah.
Yes.
It highlights this fundamental conflict that the demerger is designed to fix. It's like surgically removing this internal tug-of-war that was clearly hurting the long-term strength of the CV business, even while the PV side was recovering.
Okay, so the divorce was necessary to stop that internal conflict. Let's look at the two futures then. We've got two very different bets for investors now. TML, the trucks, seems like the more stable defensive play. India's #1 CV maker, aiming to get back to 40% market share by FY27.
That's the narrative, yes. The cash-rich engine focusing on the domestic market, infrastructure growth. Then you have TMPVL, the cars. That's the more, let's say, dynamic bet. Huge EV leadership here in India, over 70% market share.
But it carries all the Jaguar Land Rover baggage, the global volatility, right?
Exactly. And that's the heart of the market's concern now. Before, the steady cash flow from the CV business acted like a buffer, It could absorb some of JLR's ups and downs.
But now TMPVL is totally exposed. All that global risk, China demand, warranty costs, the huge EV transition needed for JLR, it's all sitting squarely on TMPVL's shoulders.
Precisely. Fully exposed. Think about the headwinds. Massive investments needed for JLR's electric future. Those rising warranty costs we've seen, vulnerability to, say, changes in Chinese consumption taxes, even just the age of some key models like the Range Rover.
Right.
And that concentration of risk, especially the global JLR risk, is why you see such a split among analysts. Target prices are all over the place. You've got Jefferies, for example, with an underperform rating targeting maybe 575,
Okay.
while someone like MK Global is much more bullish, a buy rating target 750. It just shows you it's viewed as a much higher risk, potentially higher reward play now that the CV safety net is gone.
So wrapping this up, what does it all mean for you, the listener? Essentially, the demerger gives you a very clear choice. Two distinct paths. You can invest in TML, the trucks, which is basically a bet on stable Indian infrastructure and logistics growth, or you invest in TMPVL, the cars JLR, which is a more complex gamble on the Indian consumer, the domestic EV boom, but also all that global luxury market volatility.
Well put. And maybe here's a final thought to leave you with. The new TML, the truck business, they've set that aggressive goal, right? Reclaim 40% market share. That's tough, especially after management admitted past compromises might have hurt them.
Yeah, rebuilding trust and share takes time.
But then look at the PV side, TMPVL. They're aiming for a really ambitious 18-20% domestic market share by 2030. Now that the resources aren't being shared or compromised, which leadership team, which business do you think faces the tougher climb to hit those aggressive growth targets? Something to mull over.